I think partially, if you look at kind of how fast rates moved and the market had to readjust, this digestion period, because we really haven't seen that movement kind of until we had that taper tantrum a few years ago. But I think more than anything else, you had a couple of things. One is the tariff issue, because a lot of people did think we'd get some type of resolution at this point. That's still an overhang. And then you had the elections, which will just be in a few days. But if you take all that together, markets have run pretty quickly. We had a third quarter where we were up 7%. And historically, almost every 11 months, we do get some type of correction. So these things are normal. I don't think they're something to get too overly concerned about. But when they come, there's a lot of emotion kind of to the effect of, wait a second, I just gave back my gains for the year. And now let's see where we're going to go forward from
So
that.
do you think it's been overdone at this point?
I do. I think there are some really good companies that have been sold off. If you look at the financial sector, some of those stocks are trading in single-digit multiples. We had a good earnings season through the banks. If you look at some of the industrial stocks, they're talking tariffs, and they've been sold off. Some of the home building product stocks are off 40% off their peaks. I think it's a little too far for some of these stocks to come down, and you can find good stocks to buy with good balance sheets. And by the way, corporations are still flush with cash. They have not been able to buy back stock during this period because of the quiet period. So I think the opportunities are still there, but a lot of people kind of sold first on the news and kind of said, let's just wait for the next quarter.
Hey, Rob, Jim Cramer has this thesis that there are a lot of signals that are kind of saying, look, it could be a decent time to jump back in, that we've seen a lot of things happening. One of the things he thinks we need, though, is some weaker economic data. And that would be the type of thing that would give the Fed a reason to not continue to raise rates at the same rate everyone's expecting at this point. We get the jobs number on Friday. What do you think would be a good number for the markets?
Yeah, look, we actually think we're going to get this slew of bad data over the next few months, mostly from tariffs, mostly through the manufacturing sector, that's actually going to get the Fed to push out hikes until May. Right, so we think they skipped.
You don't think they raise in December?
We think they skipped the December meeting. We think they skipped the March meeting, and that they next hike in May. The underlying bones of the economy are strong, but tariffs are going to hit the manufacturing sector hard. We've got a lot of new manufacturing establishments out there, and startups of any stripe are vulnerable to changes in cost. And this is a big change in cost for many of them.
So you think that we're going to get enough data in the next 6 weeks for the market to go from a 75% chance of a hike in December to it going away?
That's right. That's right. We do, because we think we're going to see it on Friday when we get the employment report. We're going to see real weakness in manufacturing employment that adds to the weakness we've seen over the last couple of months. We think that when we get the spending numbers in October, as well as all those holiday spending series that you see, and when we get the November jobs report on December 7th, that's going to be enough for the Fed to come out and tell us that they're not hiking in December.